All right, let's get into it. Today, we are taking a deep dive into a company that's probably in your kitchen right now, Nestle India. We're going to unpack a detailed analyst report to answer one simple question. Is this household name a stock that belongs in your portfolio? Right? I mean, pretty much everyone has had a bowl of Maggi noodles or a cup of Nescafe. But taking that love for a product and turning it into an investment decision, that is a completely different story. So, is the stock actually as good as the coffee? That's what we're here to find out. Okay, first things first, let's get our bearings. When this report came out in August of 2025, if you wanted to buy one share of Nestle India, it would have set you back 2,425 rupees. Just lock that number in your head for a second. Now, this is where things get really interesting. The analysts who wrote this report, they think the fair price for that same share is actually 2,180 rupees. And boom, right there is the whole puzzle we're trying to solve. The market is pricing it about 10% higher than what the report says it's worth. So why is that? So let's just cut to the chase. The report gives Nestle India a really high score, calling it a proficient company. But, and this is the big but, the final recommendation isn't buy, it's hold. The rest of our time here is going to be spent unpacking that. Why would a fantastic company not be a great stock to buy right this minute? To really get that hold rating, you first have to appreciate just how unbelievably good the business itself is. And that whole story, well, it starts with its rock-solid financial health. This is the bedrock of everything. And I mean, what a foundation to build on. For all practical purposes, this company is debt-free. It has a debt-to-equity ratio of just 0.02. That's basically nothing. In a world where the economy can get shaky, this gives Nestle incredible stability and the freedom to grow without being chained to huge interest payments. And this table, it tells a story of incredible efficiency. Let's take return on equity, ROE. A really simple way to think about this is, for every 100 rupees shareholders have put into the business, Nestle turns around and generates over 28 rupees in pure profit. All of these numbers are just stellar. It paints a picture of a well-oiled machine that just prints cash. So you have to ask, where does all that profit and financial strength come from? Well, it's driven by the sheer power of their brands. These brands create what investors love to call a deep moat. Basically, a huge defensive wall around the business that keeps competitors out. And just look at these numbers. This is what you call total market dominance. We're not just talking about products that sell well. These are brands that define their categories. Over 60% of the infant nutrition market. Come on. That kind of leadership gives them massive power to set prices. And how do they protect that dominance? With this number right here, 4.2 million. That's how many shops, from giant supermarkets in the city to tiny little stores in a village, sell Nestle products. This distribution network is an absolutely colossal asset. It's a massive wall for any competitor that even thinks about challenging them. Okay, so let's recap. We have a debt-free, super profitable company with brands that crush the competition and a distribution network that's second to none. It sounds, well, perfect. So what's the catch? There has to be a catch, right? Well, there is. It all comes down to the price you have to pay for all that perfection. I love this analogy from the report because it just hits the nail on the head. Everyone knows Nestle is a fantastic business. The market knows it, your neighbor knows it. The question isn't about quality. The real question for an investor is it trading at a fair price right now? And here's one of the main ways we can check that price tag, the PE ratio. You can think of it as how many years it would take for the company's earnings to pay back your initial investment. Nestle's is 24. Its competitors, they average around 18.5. So investors are willing to pay a much higher premium for every single rupee of Nestle's profit compared to its peers. So how do analysts get to that target price of 2,180? Well, a common tool is called a discounted cash flow analysis. It's a bit complex, but the idea is to predict all the cash a company will make in the future and then work backwards to see what it should be worth today. And as you can see, they run a few scenarios, an optimistic bull case, a pessimistic bear case, and the one they think is most likely, the base case, which lands us right at that 2,180 rupee target. All right, let's put all these pieces together. Let's look at the final scorecard and see how the report weighs all these different factors, the amazing quality and that one big problem, the price, to get to its final verdict. This chart tells the whole story at a glance. Look at those scores. Financial health, an 8.8. Competitive position gets a 9.0. Everything is scoring an 8 or 9 out of 10, except for one glaring exception. You can see it right there. And there it is. Valuation gets a score of just 5.8 out of 10. This is the one piece of the puzzle that just doesn't fit with the others. It's this single, much lower score that acts like an anchor, pulling that overall rating down and forcing a bit of caution. So here's how it all nets out. You average those incredible scores for quality with that one mediocre score for price, and you land at a very strong 8.2 overall, a proficient company. But because of that valuation issue, the recommendation is to hold. Basically saying, great company, but maybe wait for a better sale price. So let's boil this all down. What's the one big takeaway? The analysis is making a very clear distinction here. Nestle India is without a shadow of a doubt a fantastic company. But at its current market price, this report argues it might not be a fantastic stock to buy today. The quality is baked into the price, and then some. And that really leaves us with the ultimate question that every investor has to answer for themselves when they see a company like this. Is it worth it to pay up for a best-in-class company? The kind of business you know will be around for decades? Or is the smarter play to be patient and wait for the market to give you a better deal? The right answer? Well, that really depends on what kind of investor you are.